Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBSMoneyWatch.com, and I'm joined by the dream team, a somewhat injured dream team, right, Eric? I mean, what's his name over here? Has got the bum hip.
Oh yeah, well he's kind of gamey, but no, that's not the word. He's actually not gamey at all. Wrong word, but yeah, no, he has a young man, an extremely fit man, has an old man's hip. I don't know what to say about it.
So Jack Otter, this show is for you. You are so dedicated that even just moments after surgery, here you appear with a tie yet.
Yeah, people can't see I've got hospital pants on down below.
Right.
But the morphine is flowing, and so I'm okay.
You
I
know
will
what?
point out, it's not necessarily an old man's hip. A-Rod has the same hip.
Oh, very nice.
Sure, yeah.
That's great. And are you going to be able to hit accordingly for that hip?
I'm less worried about the hitting. Carmen Diaz is real concerned about my fitness level, and so we're working on that. Yeah,
Yeah. No, wait a second. He's got a new girlfriend, doesn't he?
yeah I'm seeing
What's her-
Carmen now.
Oh, yeah. Oh, I see. Anyways, ask the experts. Jack Otter, super duper hip ortho man, back from action. I can't believe you're here. I really am. Very impressive, don't you think?
He is an inspiration. Always has been.
As always. Anyway, this Ask the Experts, we apologize. We were started a little late because Megan had her baby. Okay, just kidding. She didn't. But I promise that we're going to try. She's sitting under a hot lamp, which Vicky, our new producer, said this is not unlike being, sort of like the little egg under the... So maybe now, at the end of this podcast, Megan, you will finally do the job. Get us a live birth, Anyway, guys, lot going on, obviously. Market's up today, thankfully, and things seem to be, rapidly changing from moment to moment with the situation in Japan and before that the Middle East. It feels like we haven't had time to breathe. So, Eric, what is a beleaguered investor to do during these tumultuous times?
God, I love it when you talk that way. A beleaguered investor in these tumultuous times should sit on his hands. A panic is no time to make any move. And so if you were investing prudently before this started, then you've done everything you possibly can or should have done, and you should wait this baby out. And today is a good indication that things don't only go in one direction, they also bounce back.
Right. And Jack...
watch basketball.
Yes, make your productivity go down, but, you'll enjoy yourself. Can there be money to be made in these kinds of markets, Jack?
There can. And some people on the correct side of the trade will make a killing. And the big problem is we don't know what the correct side of the trade is. I mean, Japan is a great example where I haven't actually seen the Nikkei today, or really yesterday in Japan's terms. But, of course, U.S. markets are surging nicely. But if you look back to Kobe, if I'm pronouncing it right,
yes.
The Nikkei was down 25% after that earthquake. So if you bet that way, well, you're a loser today. We'll see what happens in the coming days. So there's just no way to know. And people, Larry Swedrow had a great post on this where he went through crisis after crisis that has happened. And the fact is history is full of crises, and the market gets hammered, and then it comes back, and nobody knows exactly how far down it'll go or when it'll bounce back.
So that's right. And the happy ending to the Kobe story is that it was down 25% in 6 months, and then the earthquake was in January. By June, it was down 25%. By December, it was back to even.
That's the amazing thing, right? And so we always like to say to people, especially in the heat of a crisis, it's never a very good time to make a decision. And hopefully you're sticking to your guns. I kind of like the fact the market's down. I know, this is crazy. This is like I love being a bear. That's it. But I do think that it's so nice to be able to say, hey, I'm putting money in my 401k. I'm buying shares at lower prices. I don't have to be chasing everything higher. It feels okay to me.
Well, and remember, the U.S. market was up 100% without a correction during that period.
Right.
So it was really high time to get out. I mean, I'm scared to market time, but I did have to do an IRA transfer, a rollover from a 401k to an IRA.
I knew he was going to bring this up, by the way.
So I did it a couple weeks ago just because, like I said, I couldn't bring myself to just literally sell stocks, but I effectively sold stocks by having that check sent from one mutual fund company to another.
As we like to say. Why not?
And then you had it in cash?
It's now in cash because it just arrived.
Well, what are you waiting for, big shot?
So you're right, absolutely.
Here's your chance.
I got to do it right now.
All right. What are you going to buy?
I'm thinking of playing the contango in the
I love contango. Don't start talking like that. That's making me excited. What are you going to seriously? What are you going to buy?
What I'm going to buy mostly stock index funds. However, I have always shied away from the requisite 2% or whatever you want to call it in gold and commodities. And now I'm thinking with the emotional brain, but I don't want to get that allocation now because the market's been doing so well over the longer term, for the last couple of years. So I've got to decide if I can bite the bullet and start trickling into that just to get up to whatever my level is going to be, 2 or 5%, something.
What do you think?
Gold?
Yeah. What do you think, Eric?
I think it's a good idea to have some small portion of your money in gold. And, who knows about the timing, though? It's $1,300, $1,400. That's expensive insurance.
Seriously,
yeah,
but whatever. It's just doesn't really make that big a difference. That's the
true.
thing
Yeah.
that I always like when people make themselves nuts. Like, I could have gotten a 5.5% mortgage and I waited and it was 5.675. Like, really? That's what you're going to make yourself crazy about?
Yeah.
It's only a couple %.
Good perspective.
All right. Buy gold. I'm very long. Anyway, this is my pump and dump scheme right here. Let's get to some questions. If you've got, I've got plenty of gold. Don't worry. If you've got questions, give us a shout. You can go onto the website at MoneyWatch.com. We've got a chat room to which I don't have access to because Megan has, somehow become very controlling in the advanced stages of her pregnancy. Yes, true. Anyway, but she will get me the message. And you can send us an email, asktheexperts@MoneyWatch.com. We've got a bunch of questions. This is really kind of a good show to take stock of some of your investment questions. So Mitch writes us this. My 78-year-old mother-in-law just sold her house. She has $150,000 to invest. She has other investments of $250,000. She wants to maximize her current income while not subjecting her investment to too great a risk. A variable annuity from an insurance company that pays 6% was suggested by her investment advisor. Would a mutual fund of high-paying dividend stocks be a better choice? Now, can I just point out one thing? What do you mean a variable annuity that pays 6%? What are we talking? What?
Yeah.
I don't. Well, first of all, I think maybe
a multicolored white horse.
Yeah,
Yes,
I mean
right.
it's like bonus first year. Come on in.
Yes,
All right.
yeah.
So Eric, what should Mitch do?
Mitch should pay no attention to this investment advisor behind the curtain. It is that would be a mistake. This is the absolute wrong person to get a variable annuity. Now, and I would say it's probably not a good idea to buy a mutual fund with high dividend stocks either, especially if mom doesn't want to take a lot of risk. And why should she? A fixed annuity, however, is a great way to maximize income. Make sure that that money is there, and it'll pay out quite a bit more than she might expect because she's 78 years old, and annuities pay more when you're older. So I just a little calculation here on my HP12C app device.
Hold it up.
Right, this is
yeah,
a
old
very
school.
modern,
Love
thin application device.
Love it.
So if she puts all $400,000 into this into a low cost fixed annuity, fixed
Offered
immediate
through,
annuity.
give me some choices.
Vanguard, I'm
Okay.
sure, has a low cost annuity that they partner with an insurance company on, and she would get $2,500 a month for the rest of her life, no matter how long she lived.
Okay. So $400,000, $2,500 a month. Maybe she still gets some Social Security. You want to do that, Jack, or not?
Oh, absolutely. I think it's a great
ready to
deal.
rock?
We just for fun, we have to point out the insurance company through whom Vanguard produces its variable annuities.
Yeah.
I mean, excuse me, fixed annuities.
Yeah.
AIG. At least last time I checked.
Well, then that's like getting an insurance product from the government.
But I
I
was
feel
gonna
good
say,
about that.
while it's a good laugh line, I think it's
good.
completely safe.
Yeah. What about the idea that she should keep some money out, though? I mean, she's getting older. I'm sort of thinking maybe she should keep like 50 G's out of there and make sure that she has a little flexibility if she needs stuff.
Yeah, I would agree with that.
Okay.
Yes.
All right. Next one is from Mr. Barnes. He wrote us last week, and he wants to know, should he move his 401k into a hybrid annuity? And we said no. I love this. He actually acted on our advice. He writes us this week with a follow-up question. Since the annuity wasn't recommended, my advisor with Fidelity, I'm going to get back to that in a second, has suggested the lowest risk investment plan they offer, but it had about 20% invested in the stock market. My wife does not want to take any risk. So my question to you this week, is there a plan that invests in bonds that also pays more interest than the stable value plan that my 401k is presently invested in? I realize there's some risk in any investment. She just wants the lowest risk. And I like the idea of an annuity as long as it doesn't tie up the money for a long time. I found out that you can lose principal in an annuity. What do we want to do with this? Because here's Mr. Barnes. He's like, look, I don't want any risk, and I don't want even 20% in the stock market. Jack, what should he do?
I think Mr. Barnes needs to understand something that he can convey to Mrs. Barnes, and that is that stock market risk is only one kind of risk. It's the one that we hear about the most. It makes the CBS Evening News. But inflation is a big, slow, and definite, absolute guaranteed risk. There's no question that $1 today is going to be worth less 10 years from now. So 20% stocks, I actually kind of like that. If we have Armageddon, as we did in 2008, and the stock market loses half of its value, then their portfolio loses 5% in the stock. 5% goes down, but frankly, the bond portion will probably go up in that instance. So what? They're down 3% total. So really, I think actually the Fidelity Advisor, which Jill may have more to say about, is giving them pretty good advice there. If they absolutely can't stomach it, stable value funds actually look pretty good right now.
Well, I was going to say that there are some plans that have stable value funds. They're still paying 3%.
Yeah.
Right.
So
It's
you gotta
probably
check that
the
out.
last free lunch left out there. The insurance company that founded them or that is behind them, but sponsors them, has made a good bet on their bonds and is offering a very good deal.
So I think you just got to find out what the stable value is paying. And,
However, we should point out that won't last.
Right.
I mean, the bonds in that guaranteed income contract will mature, and then they'll be replaced by lower interest bonds. So,
although maybe by that time, interest rates will have risen. Oh, anyway. I just want to be very careful about, I'm not sure if this is a Fidelity advisor or an advisor who clears through Fidelity. So I just want to make sure we understand. Fidelity advisors, I actually think this is one of the weirdest things that they did not get into the advice business a long time ago. I never understood it. I thought the best platform in the world. And then they had a bunch of basically yutzes who were 25 years old giving advice to people who were trying to retire and make these big decisions. And they would go through, it was like they were talking to a call center. Well, do you have this? If answer is no, go to B. And so I have found that while I love Fidelity, I think it's an awesome company, I cannot believe they don't have a better advisory division. So not a bad thing, but in terms of what the guy what he suggested, but I don't know. I think if you want to keep it safe, then keep it safe. And if she's freaked out about stocks, even 20%, do you want to be married to the woman if God forbid the stock market goes down? Is that what you want?
Well,
you want
that's
Mr.
true.
Barnes to suffer like that?
I hear you. But
I know
he's also in a great "I told you so" position when interest rates go up. Their 80% bonds get hammered, and the only thing going up is the 20% stock.
True.
yeah,
True dat.
yeah, I think that's worth the risk.
Yeah. All right. So that's what I think we're going to say, Mr. Barnes, come on, suck it up. 20%. She can do it. All right. We like that. Another MoneyWatch user writes, I can invest $100 per month, maybe slightly more. I'm 31 years old, married with no kids yet. I need a structured approach to investing. My wife and I have our 401ks, but between that and paying for our health care, we don't invest much. Please provide direction. $100 a month. Jack Otter, where do you want to go?
I'm going stocky again. I like sounds like they don't have a whole lot of investment assets, so let's do it easy with the Vanguard Total Market Index Fund. They'll get exposure to all the stocks in the U.S. market. It's no load, so they won't pay. That's crucial with this $100 a month. You really can't buy even an ETF because you'll pay a commission each time you trade. Yep. So I would go into the Vanguard Total Market Index Fund. If you build up a bit in there, maybe you're going to branch out internationally, and that's fine. Write us in a year.
You are using your 401ks. Are you maxing them out? Because if you're not, got to do that first.
Yes.
For the extra
that is a good
$100,
point.
right?
That is a good point.
Right.
By the way, there are some ETFs that you can get into for free.
Oh, that's true. Yep.
Schwab, Fidelity.
You have to be on their platform.
Right.
Okay. Here's one from John. My wife and I have our nest egg, retirement, rainy day, emergency in a joint account and a couple of accounts in our individual names. I like that. I like to always have a little of my own money, got to tell you. Is it good or bad to split the money up like this? Does it work better to keep all of your investments with a single advisor? What do you think, Eric Schoenberg, editor-in-chief extraordinaire?
I think that this is It's psychological rather than real, and you may feel safer having your money diversified among a bunch of different platforms. I do, but I don't have any illusion that there's a high likelihood that Fidelity or Schwab will go bankrupt and take my money with it. But it makes me feel better, so if it makes you feel better, I would do it too. The downside will be, as Jill and I were talking about this before we started, was that you don't have one person overseeing it, so you don't have that kind of one overview for your whole portfolio, and that in the end, may cost you more actually than not spreading your risk out.
What do you think, Jack?
Well, I agree completely. I want to throw out one question to Jill, and that is, I think some people have read these stories. There was a Smith Barney guy in Colorado a while ago, and there have been a few others who ran away with their clients' money.
I know. It's very rare, though.
It's extremely rare. I'm not saying
I'm
this is,
laughing.
a
I feel bad for
tsunami
those
is
people, but
more likely.
That's very rare.
But Jill, if that is the worry, how do you protect yourself?
Well, first of all, a Smith Barney broker means that he should have been clearing through Smith Barney. But if you're writing a check to an individual, that's the issue. You don't write it to like Joe's investment advisor firm. If you're writing it to the custodian, which might be Fidelity or it might be Vanguard and it might be Charles Schwab, then you're kind of you want a little distance, right? So there, you want to have a few little pieces. You want to make sure anything that goes into is a custodial account where you've heard of these people. And, you can start to, if they ask for weird things like that, could you just write that check to me? Don't do it. But, really, that's the only way you can steal money. It's very hard to steal money from a client if the client has his or her own account. And that's why I don't like pooled accounts either. It's not my favorite thing. If you invest in hedge funds, you have no choice. That's just the way it is. You don't have your own single account. Okay. Oh, by the way, we got a question here from Cindy who wants to know the difference between index funds and ETFs because we just mentioned that. Jack, do you want to do a quick soliloquy, please?
Sure. The difference is a matter of structure. An ETF for commission purposes, for the way it trades, acts like a stock. If I get nervous right now and I think, oh my gosh, the market's going to tank, I can go sell that ETF, which is, in our view, actually a bad thing because I shouldn't be allowed to act on my impulses that way. But ETFs trade on the exchange, and mutual funds are baskets of stocks where you actually buy a share of that at whatever it's trading at the end of the day.
All right. And I love them. I love ETFs. Love them. Not good for small dollars, usually.
Not good for small dollars because of the commission
transaction
issue.
fee, yeah. Here we go. $100,000 in my 401k. The most tax-effective way of withdrawing that money if I'm in my 40s. May I please start by saying the most tax-effective way is to not touch it. Now, Eric, could you explain why I was so snarky about that?
Well, you don't want to pull money out of your 401k when you're 40 years old. You're not going to retire. That money is for your future self. Your future self is counting on you.
Okay, what do you do if you're really up against it?
All right, then there are some things that you can do to get the money out. Depending on how confident you are that you're going to be able to pay it back, the best way would be to take a loan against the 401k.
Right.
You can borrow up to $50,000 or 50% of your account. You pay the interest back to yourself. So as long as you continue to pay that money in, and then you end up in the same place you would have been. In fact, if the market goes down, you might end up a little bit ahead. That's not a gamble you're considering here. But anyway,
but if you lose if you lose your job, it's due.
Yes, right.
That
is a risk. Yes,
in this society where people are losing their jobs a lot, I just want to point that out. Okay, what if you can't take a loan? Let's just say you have an old 401k, right? Because it's a dormant 401k. You've already lost your job, and now you want to pull money out. Jack, what do we do?
Well, the problem is that not only do you pay taxes at ordinary income levels, I guess luckily their income might be low, so they might be in a low bracket, but you're going to pay a penalty at 10%, right?
Yeah, it's a drag.
So it's a very, very expensive thing to do.
I mean, if your back is up against the wall, I guess that's okay. Although when we had John Olsheimer on, he was talking about bankruptcy and credit and the way it affects it. He did sort of make this point that, actually if you declare bankruptcy in a lot of places, your 401k is protected. So if you're really that hard up, maybe there could be something to be said for, maybe doing something more drastic and preserving that money.
Especially if you're in a situation where, it's not a great thing to do, but if you have to empty out your 401k, then declare bankruptcy, that's even worse.
Yes, absolutely. Given what's going on in the Middle East and Japan is now a good time to invest in emerging markets. Brazil, India, Russia, Turkey, Singapore, etc., asks Michael. Eric, what do you think about the emerging markets right now? They gotten hammered before actually we started this year. I'm sorry, not this year. This period of time. It does seem like a year since this all started. Yes, thumbs up or down on the emerging markets?
I think that the emerging markets are clearly going to grow faster than the rest of the world. But what you don't know is how the stock markets are valued compared to their potential growth rate. I prefer to invest in a broadly diversified international fund and let the fund manager make the decision of how much to put in emerging markets and how much to put in developed markets.
And you can get yourself really caught up. For example, like this year, Brazil's on fire. Okay, it's an amazing growth story, fantastic economy, terrific. The stock market has gotten hammered because they have inflation, they had to raise interest rates, they had all these new rules in place, and so you own the Brazil ETF, you're kind of screwed this year, even though you made the right bet. So there is that extra layer of like, I not only have to figure out which is the best economy, then I have to figure out which one is going to have the best stock market performance.
And it's very important to remember that though it's a pretty solid bet that growth will be better in emerging markets, there have actually been academic studies that show growth does not necessarily correlate with the value of the stock market. That said, the one person in the world from whose sort of stock market prognostications I actually listen to is a guy named Jeremy Grantham.
Yeah.
If you've been watching MoneyWatch enough, you've heard his name before. And he does believe that emerging markets are going to be the place to be in the next few years. He has not been comfortable with the way they've done very well over the past, 18 months or so. He thinks that they've gotten a little ahead of themselves, but over 5 to 7 years, he thinks they're going to be one of the better performing asset classes. So I don't think it's a bad idea to have some exposure.
Just don't put all your money there.
Yeah.
Right, exactly.
Please.
We have a last question before we go. And by the way, we want to thank the 404 for lending us their podcast studio because ours, broke. This is sort of an existential question from John. Japanese culture has earned a reputation for being pride-centric, good and bad, and overly conservative when faced with the need for intrusive communications and dramatic change. Is this cultural characteristic enough reason to pull back from Japanese investments going forward? That is like a really intense question,
yes,
right?
That is a very interesting question.
So we should just, like, as a last question, kind of talk about Japan. This is a terrible human tragedy. We know that. We also talk about money, so it's kind of hard not to say, like, well, is there an opportunity? Are they going to rebuild? Is this going to be good for Japan? They've had such a rotten 2 decades. Can't something good happen there, Eric?
Yes, something good can happen. I would say that the behavior of the Japanese people in this time of tragedy and turmoil has been exemplary. And we know that they are, just not to generalize or anything, but as a nation, this is incredibly industrious, forward-looking, technologically advanced. There's no doubt whatsoever that they're going to rebuild after this. And, if you look back at the last big earthquake, as we were talking about in 1995, the stock market was up again, and it has grown since then. I would say that it would be quite a leap from from whatever shortcomings you might find in Japanese culture to say that it's not a good investment on the basis of that.
Yeah, I would say the issues in Japan are much more tied to the fact that they had this enormous bull market up until 1989 that's been going down for 20 years. So you're clearly fighting that tape, although it will hit bottom at some point. Mm-hmm. And the fact that you've got some issues there. I think we talk about debt here. Their debt is 200% of GDP.
You know what's kind of wild about
interest
that?
Interest rates are rock bottom.
But that debt is 200%. Do you know who owns Japanese debt? I just read this. I had no idea. 95% of Japanese debt is owned by Japanese individuals.
Yeah.
Japanese individuals.
Isn't that wild? I couldn't believe that.
Yeah, Japanese individuals have very little exposure to their own stock market relative to the rest of the developed world.
Exactly. So, look, our hearts and our prayers go out to, this is just such a terrible situation. We are going to continue to cover it because this is what we do. And I know it's a little bit unseemly for some people. Doesn't mean we don't have hearts. We actually do. But our job here is to make sure you don't do something stupid in the middle of all of this, and to make sure that if you can make some money, we help you do that, right?
And I will throw out one tidbit. An old friend of mine taught English in Japan after getting out of college. He hung around and started a hedge fund. It's a long-short fund that invests in Japan, so he's been doing okay for 20 years, 4,
Wow.
5, 6%. And here's the thing that he says he's been looking for the past 10 years before he increases his long position. In other words, as this guy's saying, invest in Japan. He wants inflation. He says, once I see inflation in Japan, then I'll know it's finally broken out of this 20-year losing streak.
Wow. Well, there's a hope.
That's my tip for the day.
All right. Guys, you have to go to the doctor.
I do, yeah.
All right. Well, thank you so much for doing this. And
Always.
Thanks to Megan for somehow pulling this off. Roland running the board and learning an entire new system within, 6 minutes. So we thank you. We thank everybody who was watching today. And if you've got more questions, we'll be here next week. And the email address is asktheexperts@moneywatch.com. I'm Jill Schlesinger.
I'm Eric Schoenberg. Take care of that hip, Jack.
Yeah, really.
And I'm Jack Otter with the bad hip.
Yeah, Jack, the bad hip. Thanks for watching. We'll see you next week.